Welcome to the McQuadeBrennan 2012 Accounting and Auditing Update Seminar. Our discussion leader today is Dr. Gary Bulmash, a CPA who's also a professor at the University of Maryland. Our program today is in two parts. In part one, Dr. Bulmash will talk about general accounting and auditing updates for 2012. In the second part, Dr. Bulmash will discuss specific changes to standards for 2012 and also the AICPA Clarity Project. We think you'll find this video informative. Thank you very much.
Now, when the PCAOB was set up by what famous law? Of course, you can't have an accounting seminar without mentioning Sarbanes-Oxley, agreed? So we've mentioned it, so we can go home now. The PCAOB was set up and given the charge for public entities. Meanwhile, the ASB, right under that, which stands for the other A word, the Auditing Standards Board had always issued SASs, Statements on Auditing Standards. Now, these guys, you know the old saying, see the handwriting on the wall. And the handwriting says, you guys will soon be out of business. So the Auditing Standards Board goes, oh, we'll issue standards for audits of non-public entities. We're going to talk about them a lot today because they get involved with that Clarity Project, which we'll be talking about later. But in any event, we'll come back to that. ARSC. Okay, question, you do any comps or reviews? Okay, the governing authoritative documents are SARS, right? And that's Accounting and Review Services Committee. It's all part of the AICPA. Okay, the next one, what's the I? Obviously, right, International Federation of Accountants. Located in, and I'll give you a hint, North America. This is fun, we're playing a little geography. Sorry? I thought you said something else.
Connecticut?
No, but you're close. You're in New York City. Now, I want to spend a few minutes on international and then a little bit of time on the big gap, little gap issue. So, and I don't have too many notes on this, so it's basically talking. I mean, we certainly have read a lot about the United States moving toward international, you know, on and on and on. Every year for the last 5 years, I have said, in 5 years, the United States will be on IFRS. Excuse me, I am going to now sing a new song. In 15 years, excuse me, a lot of people, and more, are thinking, never. We're never going to get on IFRS. And you know, right or wrong, good or bad, I don't know what the answer is there. Why am I going from 5 to 15? And then we'll come back to why are people saying never. But in any event, the SEC makes the decision. And they made a decision a couple months ago. Now, people thought their decision would be one extreme or the other. One extreme, United States gets on IFRS, US GAAP is history. The other extreme, United States stays on US GAAP and we tell IFRS where to get off, so to speak. Okay, so this is political. No matter how you slice it, everything's political. They didn't come down on the extremes. They got in the middle. Let's say your client is a real estate entity started in 1980. Has a lot of land and building. Okay, the year 2000 comes and they decide to adopt the revaluation model. So they get everything appraised and they make all the journal entries they're supposed to make. Okay, you're now getting ready to do, assume it's a calendar year company, the 2012 financials. And you go in there and they say, well, we haven't had any of this stuff appraised since the year 2000. And they say, but we're on the revaluation model. Your response is, no, you're not. You're not on the revaluation model because you have to have it appraised, you know, within a 3-year period. You're well beyond that. Excuse me, so they'll say, well, we're on the historical cost model. What are you going to say? You're not historical cost. Your historical cost was the 1980 number. You got a number from the year 2000, and you wrote you wrote that up, you wrote everything up to that number. So what model are they on? They're on the non-GAAP model. Agreed? Yeah, that's right. Actually, if that's their major assets and they wrote them up, it's probably going to be adverse because, I mean, the financial statements will not fairly present. Agreed? We're going to talk about audits later in the day with the Clarity Project. Where are we with international? Well, it's kind of at a stalemate at the moment. But again, I've seen articles where people have said, well, you know what, we're probably not going to get there. The FASB and the IASB have been working on 3 joint projects, a lot of joint projects, but 3 major ones. Can you name them? I'll give you each $1,000 for everyone you name. But for everyone you don't name, you each give me $10,000. Is that fair? And I'll treat you to lunch. How's that sound? Okay, one of them I mentioned a few minutes ago, actually. Dr. Linnell. E-A. Right? Okay, does that count as 10? Did that count as 1,000? No, because I gave you a hint. Leases, that's correct. We'll talk about that. Revenue recognition and financial instruments, they're the big 3. And what happened was, both groups were working on this, and they had exposure drafts out, and they really thought they'd have these standards finalized, and everybody would be on the street hugging and kissing each other. Now listen to this date. By December 31, 2011. Guess what? Didn't happen. Everything's postponed and postponed. So a lot of people are now saying, you know, this is terrible. You guys couldn't agree on these things, and there's still, I mean, they agreed on a lot of it, but some of it's still up in the air. And then what will happen, I think, you know, what I see happening here with these projects is the boards will just give up. You know, it's, you take your toys and go there, and I'll take my toys and go there, and we don't have to work together on everything. Some people are being frustrated saying that the SEC was waiting to see if they could come to some agreement, and the fact that they didn't was why the SEC didn't make that decision to adopt it now. I mean, I've heard people say there are too many cultural differences. I've heard people say there's no real reason for the United States to be on IFRS, but again, it's a matter of opinion. So where do we stand? Don't forget about the subject, but it's not as big a deal as it was a couple years ago. So then you're in holiday season for a month, a little over a month, and then it's January. So most of the firms that would really be interested in this, you know, it's hitting them at a time when, you know, holiday season. Okay, maybe you're not as busy at work, but the bottom line is, you know, who wants to deal with stuff like that? Then it's January and you're busy with other things. So it's almost like during a time that it's going to be difficult to comment. Now, to be fair, maybe the thought process was most of the comments that these, you know, firms like yourselves, most of those comments would probably be very positive. Hey, we like this. But again, back to another point I was making. The AICPA has always been accused of leaning toward the big firms, the big guys. When the AICPA puts out a document like that, then they can walk around, you know, patting themselves on the back and bragging, hey, local practitioners, look what we're doing for you. So I think they're trying to get some PR mileage out of that, if you know what I mean. When you call the, have you ever had occasion to call the AICPA other than the hotline? Excuse me. Don't turn the page yet. Don't turn the page yet. Should we throw him out?
Just come on.
I don't like blood. The whole issue of going concern. Let's go over that, because that's a very important subject. What's the time frame in the United States? No more than 1 year from it's balance sheet date, actually. A lot of firms have told me they use date of issuance, but technically the standard says balance sheet date. The IFRS rule, are you ready for a principles-based rule? The IFRS rule is at least but not limited to 1 year. Now think about that. You're a staff member. Partner comes up to you and says, here, evaluate all this and tell me excuse me, if you think there's a going concern problem, at least but not limited to 1 year, what are you going to say? You're going to throw your hands up in the air, and you're going to say, you'll say to the partner, idiot. Do you call partners idiots? I hope not. Oh, they do? You'll say, for heaven's sakes, give me a time frame. At least but not limited to 1 year is too open-ended, right? But again, that's back to principles-based, and rules, we're a rule. The FASB was trying to come up with that, at least but not limited to 1 year, but my understanding is it's been abandoned. Cash flow statement, I think, is a fantastic statement. Why? Most people are going to think cash flow. Most people aren't going to think accrual basis. Agreed? Another point. We say cash and income aren't the same. We mentioned that earlier. One way to explain that is show a client the cash flow statement. You start with net income, and you have adjustments. These are items that affected net income, but did not affect cash. That's exactly right. So these are some of the differences, items causing the difference. Now, do any of you remember the predecessor to the cash flow statement? That's right. In financial position. You're much too young to remember that. This goes back to the 19... Oh, okay, one of my textbooks. This goes back to the 1980s. It was a statement similar to a cash flow statement. The format was a little different because it was basically sources and uses. But you didn't have operating, investing, financing. But also it was working capital. It wasn't just cash. And I'll tell you a little story. Many years ago, in the 1970s, for a couple of years, I worked for the AICPA, writing questions for the CPA exam. The very first exam that was given when I worked there was November of '73. And I asked my boss if I could, all the exams were graded in New York at that time, I asked if I could spend a couple hours on the grading floor just to see what it was like. So I think what he did was call over there and say, my guy's coming over, humor him. So I went over and I spoke to the person in charge, and a person graded a given problem. So you become an expert on that problem. So he showed me the exam. He said, what would you like to grade? So there was a statement of changes in financial position. I always like that stuff. So I said, I'll grade that one. And again, for those of you who aren't familiar with this, the concept is like a cash flow statement. It's basically where did it come from and where did it go? Okay, so I start grading them. I come across a paper. This person obviously had no clue what a statement of changes in financial position was. So the person in the answer, the person wrote, cash, the company has a lot of cash. Receivables, the company has a lot of receivables. Went through every account. And we're sitting in this huge room at tables, grading, and I'm trying to go like this to keep from laughing. Finally, at the end of the answer, the person wrote, income tax. Nobody likes paying income tax, but it's better than not having income. Well, that did it. I laughed out loud. I read it out loud, and everybody laughed. So I said, this is a 0. So the supervisor came running over to me and said, you got to give the person 1 point. I said, what for? Entertainment? He said, no, for trying. I said, that's not trying. He said, I know that, but that's the policy. So I erased it and made it 1. Now, I tell this story all over the place. I'm waiting for one day. The hand to go up. Thank you for that point. When you're talking about, remember what we talked about when we started this morning? The PCC, which stands for? Private Company Counsel is right. That, they have this list or tentative list of subjects to pull out of GAAP for non-public entities. Remember the key point? My understanding is this is very high up on the list, which it should be. And also another thing that's supposedly high on the list is uncertain tax positions. These are more pains in the neck than anything else, agreed? But in any event, let me tell you a situation with variable interest entities and tell you what I've heard over the years at these accounting conferences. The example I've always traditionally given is Mr. and Mrs. Corporation leases land and building from Mr. and Mrs. LLC. Same Mr. and Mrs. obviously. The the LLC, is it a variable interest entity? And if so, is the corporation the primary beneficiary? If the corporation is the primary beneficiary, the corporation has to consolidate the LLC. That's the whole point. Now, I've always said, let's assume the rental charged is a fair rental and the cash flow generated by the LLC can service the debt. And if the corporation moved out, they could go find somebody else to lease it. In other words, the LLC is pretty much a self-sustaining entity. I've always said, you don't have to consolidate. A couple years ago, at the AICPA conference, the one they always hold in the summer, a speaker from the FASB said, no, absolutely, you have to consolidate that. And people were screaming because they were using the example similar to what I just said. Well, what they're saying, this is what he said. He said the LLC was set up to benefit the corporation by providing the land and building. In other words, for legal and for valid legal and tax reasons, you're putting the land and building in a separate entity, and that's valid. There's nothing wrong with that. That's not fraudulent. But it was set up primarily to benefit. That's what he said. People were screaming, no, it's self-sustaining, blah, 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 on and on. Okay, so then I started telling people, you do have to consolidate. One of the firms that I was doing a seminar, one of the partners said he called the AICPA hotline and spoke to a guy named Arthur. Did you ever talk to Arthur?
Yes.
Okay, and Arthur said you absolutely do not have to consolidate that. That the purpose of this was to make it easier for non-public entities. So I called and I spoke to Arthur and he said the same thing. And I said to him, I said, everything you're saying makes sense. It's logical. That's why I'm concerned about it. Although other people have told me other people give them a different answer at the hotline. Okay, at this year's conference, the one this past summer, it's about 1,000 people. So you go into lunch, there's a big room, and you sit down at a round table, you start talking to the people around you. So I'm sitting down talking to people, mostly empty table, and a whole group of people from the AICPA just by coincidence sat at that table. So I was sitting right next to Chuck Landis, who's pretty high up, he's Vice President, Auditing Standards or something. So I thought, I'll run this by him. So I brought it up to him, and he said, well, he's not giving me the absolute definitive answer, but what he said made a lot of sense to me. He said, if the property that's leased is very specialized, it's so specialized that if the corporation moves out, they really have nobody who can use it, then that LLC truly was to benefit the corporation. But if it's an office in an office building, and X moves out, Y can move in, then it's not to benefit the corporation. I thought that was a very good explanation. So that's what I'm telling people this year. Every year I tell people something based on what I hear there.
Consolidate.
Yeah, unconsolidate, deconsolidate. Now, a lot of this, honestly and truly, is a function of your peer reviewers. Because if you go back to the main purpose, it was, again, Enron and all that off-balance sheet stuff. And for a big company, I can see where this makes sense. But for a small company, I think it's beyond overkill. Why? Your client, Mr. or Mrs., go to the bank for any kind of loan. The bank wants to know every single thing they're involved with. Nothing is being hidden here. So, and all related party transactions are disclosed, et cetera, et cetera. So again, this is another example of overkill. And this is another reason why we need, I'm going to say a bad word, big gap, little gap. But you know what I mean, right? Your client is an American company. They get a customer in France who will buy whatever it is they're selling and a fair price that they've agreed on. The customer in France says, in 1 month, in 30 days, I will pay you 100,000 euros. Now, the fancy word here is, this transaction is denominated in euros, which means who has the risk of foreign currency fluctuation? Could be risk or it could be good, of course. Who's bearing that possible risk? Which company? It'd be the American company, right? Because the other company is paying 100,000 euros no matter what happens to the exchange rate. The American company is getting 100,000 euros in 30 days. Okay, journal entries. We got to do journal entries because you're getting 8 hours of A&A, right? Debit, AR, and credit sales. On the day of the sale, 100,000 times exchange rate that day. Okay, a month later, debit cash for 100,000 times the exchange rate that day. Credit AR for the original debit, obviously. Your plug figure, debit or credit, is a foreign currency transaction, gain or loss, through the income statement. That's the point. That goes through the income statement. Now, there are ways you can hedge and things like that, yes. But it all goes through the income statement. That's the point. Now, translation. American parent owns a British sub. British sub is in pounds. Now, to consolidate, we need to translate. Are we going pounds to TO dollars? Or dollars, TO pounds? Pounds to dollars. Greg says pounds to dollars. What's the correct answer? Right, I wanted to see what they'd say. They supported you.
I appreciate this.
You go, think about it this way. TO, the monetary unit of the parent. Doesn't that make sense?
Mm-hmm.
Okay, have a trial balance that balances in British pounds. If you multiply everything on there by the same ratio, you're going to balance in US dollars, subject to a little bit of difference due to rounding. But it's not that simple. You don't multiply everything times the same rate, which means when you get to US dollars, you're not going to balance other than by sheer, absolute, pure coincidence. Probability of that is really tiny. Okay, you need a plug figure. The plug figure is the translation adjustment. Makes the balance sheet balance. But double entry bookkeeping, we need an offset. Most situations, this will be OCI. It depends on a number of variables, like which method you're using, but the most common, it'll be OCI. Never seen it go through the income statement. No, but there is a possibility if you elect a different method. The whole, all kind of nonsense with the functional currency, and it gets involved. Everything gets involved, right? You know, the bottom line is if you're not using the most current reports, etc., you're not necessarily building in the most current standards. And that is very important.
Derek, do you know why they make those standards for the years prior to December 15th?
Yeah, 16, 17. By the way, publicly traded are now called issuers, and non-public are now called non-issuers. They're Sarbanes-Oxley terms. Number 18. How many of you have pleasant memories of economics in college? You shaking your, Brian, you shaking your head yes? Okay. You're one of the very few who shake head yes to that, let me tell you. This is an economics term. What's opportunity cost? It's the benefit you give up.
To have something else.
Right. So I have an option A and option B. I select option A. What benefit would I have gotten in option B that I gave up? Now, how do we measure that in financial accounting?
We don't.
Right. That would be the epitome of subjectivity, wouldn't it? There's no way you could come up with a number for this. Many years ago, I was teaching a seminar, and I came across something which is now called managerial accounting. Most of us called it cost accounting, fixed cost, variable cost. So I said, how many of you have pleasant memories of cost accounting in college? And one guy raised his hand and he said, do you mean the first time I took it or the second? I tell my students that story. I think that's funny. And uncertain tax positions, what about that baby? Have you played around with that one?
It's very troubling for small businesses.
Very. Every time I've heard someone talk about this, they've referred to the GAAP rule as a roadmap. A roadmap to whom? Yeah. IRS comes in and looks at this and says, oh, you thought we would disallow such and such. Guess what? I mean, it's beyond ridiculous. This is another thing, as I said, I think is high on the list to pull out for non-public entities. Another point. For most entities that you're doing, working on financials and giving audit review compilation report, are you also doing the tax return? Okay, so where you're doing the tax return, your argument could be, hey, if it was that much of an issue when we did the tax return, I wouldn't have let the client do it. So therefore, by definition, there are no uncertain tax positions. You've in your mind resolved them. I mean, again, it's a matter of judgment, but you've resolved them. Where someone else has done the tax return, then it's more of an issue. from time to time, it doesn't hurt to revisit something like this. Very important to be alert. When you're doing any kind of work at a client's place of business, be alert as to what's going on there. You'd be amazed at what you can learn just by paying attention. The word audit literally stems from a Latin root AUD, which means what? It doesn't mean tick and tie. That's exactly what it means. Listen, pay attention to what's going on. You'd be amazed at what you learn. Now, does that mean you're at a client's place of business? Somebody gets a phone call. You pick up another phone and listen in. At least you should cover it up so they don't hear you breathing, right? No, that's being absurd. You don't have to be absurd in the process. But common sense, pay attention. Now, I'm going to ask another question. I don't want to embarrass anybody or get anybody in trouble or anything like that. But if you ever, I don't know how I'm going to word this. Okay, let me tell you a story, what is leading me to this, and I won't ask you about it. I'll just tell you as a story. Hopefully you'll see what I mean. A couple years ago, I went to a conference. Big CPA firms sometimes sponsor these conferences for accounting educators, and they pay all expenses and all that. And this was a 2-day conference in Disney area. So I made the sacrifice and I went. And it was, I think it was the Louis. Excuse me, and one of the partners, an older gentleman, was telling a story. He said a lot of their younger staff, it's a cultural thing, and an aged generational thing, will sit there working with their ears plugged in, et cetera, listening to music or whatever. And he said they were at a client's place of business, and the person was sitting there like this, and the top person, the client, was standing here like this, talking to him, and the guy went like this, "Are you talking to me?" So when he told that story, my reaction was, "Oh my God, that's terrible." I really thought that was terrible. Then I happened to have, at another function, run into another partner, coincidentally from Deloitte. This is a young woman, and so I don't know if it's the age or the, that makes the difference here. And I ran that by her. I said, "What do you think?" And she said she uses this theory that some people, when they're like that, can stay focused better. And I want them to be focused on what they're doing. And she said, as long as the client is not objecting, I have no problem with it. I've run that by a number of people, and again, I'm not saying what's right or what's wrong. I'm telling you different points of view. I've heard some people say, in the office, that's fine if employees do that. At a client, we prefer they don't. That's what I've heard some people say. And that, again, I'm hearing different points of view, because my first thought was I was livid. This is terrible, at that point. But the other side of the coin, to support what my original thought process was, I just said that you learn a lot by paying attention to what's going on when you're in an environment. If you're sitting there like this in your own little world, you don't know what's going on around you. So again, these are different arguments. I'm not saying what's right and what's wrong, and I'm not trying to cause any trouble. Cash and income are not the same. However, over a series of years, if a company is constantly reporting accounting income, and that never translates to positive cash from operations, something is wrong. This is a possible indicator of fraud. Why? Either the cash isn't flowing through the way it should, it's going in somebody's pocket, or the accounting net income number is phony baloney garbage. That's fraud also. So that's an interesting point. And we'll chat for a few minutes about one of my favorite financial statements in the world, a cash flow statement. Sometimes I have parties, people come over and we sit around and do cash flow statements. Who would like to attend one of my parties? Are you laughing with me? I always use lines like that in a college class, and everybody laughs, like, stupid, who's going to go to a party like that, But at the end of the semester, suddenly hands go up, because they get extra credit. Think of a cash flow statement. We have 3 sections, operating, investing, and financing. And what this little chart has done, which I took out of a textbook, I thought it's a nice little summary. A cash flow statement is a very analytical statement. You can learn a lot about a company by looking at that. The first 4 situations, positive means cash inflow, negative means cash outflow. The first 4 are positive operating, and the next 4 are negative operating, right? And then we have all kind of other combinations. Okay, now let's think about this for a minute. Look at number 8. Would you agree number 8 is not a good situation? You can't stay like this too long. Okay, so what do you learn from this? Let's see. Good or bad? Let's say we see on the indirect method increase in inventory, increase in receivables. Okay, increase in receivables, increase in inventory. Good or bad? I always tell my students, whenever I ask a question like that and say good or bad, the correct answer is, it depends. It depends on what? Okay, increase in inventory, increase in receivables. Look at related accounts. Look at sales. Okay, if sales are going up and business activity is going up, that's probably fine. It just falls in line. But is it possible receivables are going up but sales are going down? That would suggest. Okay, well, we'll look at inventory in a minute. Just receivables. Receivables are going up when sales are going down. That would suggest they're not collecting cash, which is bad. Or inventory going up, that would suggest they're not selling it, which is bad. So you gotta relate items. You don't just look at one item, you look at other things too. Okay, PP&E in an investing section. PP&E goes up. Good or bad? See, everybody knows the answer is it depends, but your thinking depends on what. Well, PP&E going up, I don't mean just replacement. It looks like they're really buying a lot of new stuff. Would suggest expansion. Good or bad? Okay, gut answer, good. We're profitable like this, we'll be phenomenal like this. Is that guaranteed? Nothing is guaranteed. Could a company grow too rapidly and get in trouble? Sure. Why? Why might that happen? Yeah, well, it could be part of the supply chain. I mean, the idea is
you have to have money to finance those.
Cash is the key word. In other words, I'm growing. The demand for cash starts moving up. Why? To buy things, supply chain, the customer chain, everything. The demand for cash moves up. If the supply doesn't move with it, you're going to have a problem. Simple as that. Okay, a company is shrinking, so they're selling off PP&E. Gut answer, bad, because gut answer, they're in trouble, they got to shrink down. Could a company shrink down and operate profitably at that lower level? Very possible. And that would be largely based on whether they're fixed cost oriented or variable cost oriented. Agreed? Okay, financing. Companies borrowing money. Good or bad? Okay, again, most of you are going to think of the negative here. The negative being eventually you'll be top heavy with debt. You'll be too risky. Nobody will look at you. Okay, it could be part of an expansion. That's right, which goes with maybe we're borrowing money to buy PP&E. Another point, though. You're borrowing money, and let's assume it's from a third party, a bank or something, not from the owners. Some third party out there had enough faith in you to lend you money. That's a positive. Another point is possible positive financial leverage. What's that mean? How many of you have pleasant memories of college finance? David doesn't have a pleasant memory of college finance. Ryan, you do?
Grow your rate of return.
Yeah, think about it this way. You borrow money at 5%. If you can earn more than 5% on that money, you are making money on other people's money. That's very good, agreed? The increment will accrue to the shareholders. Now, what I just described as positive financial leverage going up will really hit you in the face going down, so it could work in reverse.